Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall. On this episode, we're talking about recent bank M&A activity, the drivers of transactions, the impact of the election on the group, valuations broadly, and what all that means for capital raising. Coming back on the show to talk about all that is Bill Burgess, co-head of the Financial Services Investment Banking Group at Piper Sandler. Bill, thanks for coming back on the show.
Thanks for having me, Nate.
So, Bill, it's late November 2024. I feel like we're seeing some green shoots of recovery in deals. The last two quarters, second and third, were a little better what we'd seen in 23 and 22. And maybe more notably, we've seen $5 billion plus deals in 24, including two in this quarter. And the most recent, which came this week, just yesterday, with Old National and Bremer Financial. So it seems like we might be finally getting the long-awaited pickup in M&A activity we've been waiting for. What does your M&A pipeline look like? And are the reasons to sell the same?
Our bank M&A pipeline is much better today than it was a month ago. There's no denying that. We are seeing more strategic board meetings, more new engagements, more buy-side conflict checks for M&A processes. The outlook is terrific. I think that it makes sense to talk about why that has changed post-election as well. And I can think of 6 reasons. The first is just pent-up demand. Bank M&A has been largely dormant for the last couple of years, and that has to change. The second is that the recent bank stock rally has improved seller psychology. It's easier to sell when your stock is at or near an all-time high, and it certainly helps buyers' capacity to pay. Math.
Right.
Interest rate marks are more manageable today, and they're becoming more manageable because time helps. There's an increased importance of scale, and it's more demonstrable too. You can look at the size correlation with stock valuations and efficiency ratios. Scale increasingly matters. The last two are important. There's an expectation that the regulatory application processing period will become shorter and less contentious. Ask banks like U.S. Bank, BMO, or Columbia about the detrimental impact of approval times that take more than a year. Also, if merger applications are permitted to be multiple, more than 2, more than 3 at a time, if that's no longer taboo, we can see a dramatic rise in M&A volume, particularly for targets below $1 billion in assets. And finally, investor acceptance is on the rise. Old National, as you mentioned, announced a $1.4 billion deal yesterday, and their stock price rose 5% at the end of the day. Not every deal will be as well received as Bremer Old National, but investors are certainly now more open to deals.
Yeah, I mentioned billion plus deals this year, and we looked at that yesterday. I think every other buyer had seen some pressure on the day of announcement. That kind of pop definitely stands out and definitely spoke to me as investors being receptive to at least smartly priced deals. On the merger application fronts too, I want to pick up on that just a little bit. 90% of deals involve targets with $1 billion assets or less, right? But we've kind of seen for some time now, it's hard to be a serial acquirer, multiple deals in a year. And are you alluding to just the fact that many of the experienced acquirers we'd seen historically would be able to put up, more than 1, maybe 2 a year, and that just suddenly generates a lot more activity?
That's correct. I'm always reminded by the old-time bankers about Norwest that would have a transaction announced every 6 to 12 weeks, and how they lament that kind of a pace cannot be replicated with today's regulatory environment. I don't anticipate that will transpire in 2025, but how about being able to fire more than one bullet a year versus having to select the one deal you can do every 18 months? That would be a real improvement.
For sure. I mean, if you're at 1, that's double. So obviously that's a big difference. That makes me think about, though, or if you're seeing more buyers and sellers in the market, because I feel like I've heard you say over the last year that we have seen more sellers and there's not as many buyers simply because of that that dynamic alone, that you can't come back to the whale that often. Is that still the case? And what is driving buying activity?
Well, I think the number of buyers and sellers in some ways depends on the size of the seller. When I started investment banking in 1998, there were 10,500 U.S. banks, and today there's just over 4,500. On average, the number of banks has been reduced 3.3% annually. It's only been 1% this year to date. It was below 3% the last 2 years, and that's about to change and change pretty quickly. There's 3,500 banks in the United States under $1 billion of assets, and consolidation there is inevitable. But how? First off, private mergers are nearly impossible to execute, and as painful as cooking bacon naked. That is not the long-term solution. Banks these size need to find an exit through larger consolidators, and they better raise their hand soon. And by that I mean now, if they want to find a merger partner in 2025. Otherwise, they're going to have to wait in line, waiting for the limited number of acquirers to be ready. And by the way, when you say more buyers versus sellers, I mean some markets have only a few consolidators. And they can't right now keep up with the incoming phone calls. In markets like Chicago or Wisconsin, a few buyers really hold all the cards, and they will use that leverage very carefully and smartly over the coming months. I think large cap M&A, however, is very different. And I do think that large bank deals are about to return from hibernation. The last commercial bank deal announced with a target over $100 billion of assets was at the end of 2021. And that was BMO, Bank of the West. There has not been a red light for large cap M&A over the last few years. It has been a do not enter sign. So large cap acquirers I've spoken with over the last few years have been open about the fact that, why they haven't pursued M&A. They say, Bill, before I walk onto the playing field, I kind of need to know the rules of the game. Tell me the parameters, and I'll abide by them. And that hopefully is about to change. In the large cap universe, which is going to be the focus, I think, of kind of the press, there are 4 $2 trillion asset banks. The second tier is 4 banks between $500 billion and $700 billion. The second tier wants to bridge the gap between them and Wells Fargo, who's 3 times their size. It'll be very interesting to see how they accomplish that. The next tier are 9 banks between 100 and 250 in assets. This is 250 billion. And they're 40% of the size of the tier 2 banks. And they're going to act in 2025 as well. They've been dormant far too long. Finally, whether the Trump administration moves the SIFI threshold from $100 billion back to $250 billion is monumental. The cost of crossing $100 billion of assets is very significant. We estimate to be 10 to 15% of EPS. And to put that in context, a 1% ROA on a $100 billion bank is $1 billion of earnings. So 10 to 15% of friction is $100 to $150 million of lost earnings. Ask New York community, about how impactful the increased regulatory oversight can be once you cross through that threshold. So, we'll have to see how they approach that SIFI threshold. If they move it back, it's really going to accelerate consolidation between the 25 and half a trillion asset banks. As for timing, one of the questions I'm getting is why hasn't this happened yet? And it's going to take longer than today's ADD public is accustomed to. Today we are kind of used to clicking on Amazon and getting whatever we want today or tomorrow, and bank M&A is coming back, but it's going to take some time. Larger banks want to see the new regulatory heads in place, and in some cases have discussions with the new decision makers. They want to kind of know the rules before they head back onto the playing field, and who can blame them? I feel a little like Aaron Rodgers talking to the nervous Green Bay Packer media a few years ago. He calmly told them to relax in 2014, and then took that team to the NFC Championship game. To those who are asking why we haven't seen a redux of 1998, I simply say, relax.
Yeah, and important for our audience to listen there that you said 2014 Aaron Rodgers, not 2024 Aaron Rodgers. Let's not go there, right? We're looking back to MVP years when we're talking about potential M&A return here.
As a Patriots fan, I love where he is today, and I hope for another redux in 2025 for the Jets.
Well, and to your point about taking some time, not only from seeing the regulatory heads and testing, but it takes time to pursue a deal like that, particularly for an organization of that side. It sounds like you think that they need to see maybe not a complete all clear, but they need to see a change before they're going to dedicate those resources to actually really start those discussions in earnest.
That's right. And my brethren are encouraging them to move now, and the pushback has been, let's see who is in place at the tops of each of the agencies, and having a conversation to make sure that all is clear is worthwhile. I mean, these CEOs didn't get to where they are for $100 billion plus institutions without being prudent with risk, and waiting a quarter or two to make sure that the do not enter sign has been removed and you have a green light is prudent.
Certainly. Well, I want to shift to a discussion around capital raising, because we've seen capital required with a lot of deals, and it's been there. And that's important because like M&A activity, it was pretty anemic in 22 and from much of 23. And so you're starting to see capital come back in the sector. But what we've seen that I think is more striking in the last 6 months is more opportunistic raises, including for things like restructuring the bond portfolio. I know Piper Sandler's worked on a ton of those transactions, and the firm's going to talk about those strategies more at the upcoming balance sheet strategy seminar in New York on December 9th. I know you'll be there. I'm delighted to be a participant again and look forward to hear what Scott Hildebrand and team have to say there. But one question I'm sure any banker thinking about that kind of transaction has is really how open are the capital markets? What is investor appetite to support our paper look like today, and how does it compare to 6 months ago?
Investors are eager to invest in banks today. The sector rotation of dollars into financials has begun, in many ways the same way it did in 2016 with the election of Donald Trump. Bank stock prices are up. Over 90% of the top 200 publicly traded banks that we track on a weekly basis are up year to date. And the median 2024 PE is now over 14. We had a Piper Sandler East Coast Financial Services Conference in Naples a few weeks ago, and the general mood for investors was euphoric. And so I think there's certainly investor interest in the space. Event-driven capital raises are plentiful, and we've seen them thus far tied to balance sheet restructurings, and some examples there would include Dime, Amerant, and Midwest One Financial. We've seen capital raises tied to announced M&A transactions, and examples there include Old National yesterday, Renaissance, Atlantic Union, UMB Financial. I mean, equity capital is absolutely available. With the rise in share prices, though, we're seeing maybe a little too much euphoria with respect to capital raises. My competitors have lost their collective minds trying to encourage every bank with a ticker to issue capital just because their share price has risen. And reverse inquiries also abound. And by that I mean investors are calling our equity capital markets desk with a list of names that they are interested to invest in. They're also calling the companies as well to say, frankly, we don't think that you need to raise capital, but if you do, we would very much like to be a participant in any equity offering, either tied to a transaction or just tied to growth capital.
I've been asking the question on any of those deals how investors were getting comfort with the transaction, but it sounds like it almost is they're chomping at the bit. They're ready to put money to work after being on the sidelines for some time. Do you think that's a fair statement?
I do. I think that, well, it depends on the event too. If there's some transactions that don't warrant capital or execution, but I think again, investors are embracing event-driven deals. I mean, the biggest complaint we see is that investors sometimes are not included in these offerings. Most of these transactions that we're talking about, if they're tied to a balance sheet restructuring or to an M&A deal, are done confidentially overnight. And that means that the number of investors that you can bring over the wall is limited. And so my advice is to make sure your underwriter understands your shareholder base so that you can reward those long-term shareholders that have been in your stock and want to continue to maintain their ownership percentage, and would certainly want to buy at a discount, and not bring in an underwriter who's going to reward their hedge fund clients who will buy it at a discount and dump the stock a day later. I obviously have some suggestion as to what investment bank can help best. But I will say that the posturing for investors to make sure that they are on that list of wall-crossed investors has increased, and understandably so.
So capital's back. Obviously, it comes with a price, but there's been some banks who probably would have loved to have played offense 6 months, 12 months ago, and it might have been too punitive or maybe not even available. If you want to play offense, should you go get capital now to do so? And if you've got really good opportunities in your market, and what are the best ways to do that? I know something you've mentioned in previously is the idea of something like an at-the-market offering. Talk a little bit about how you would counsel one of your clients and the different structures that you think they could take.
Sure. So while we don't know the capital is available for transaction-related issuances, we should also note that one of the reasons that bank stocks are up for 2024 post-election is the expectation there's going to be a more robust economy, and the expectations that loan demand will be greater in 2025. And some banks are going to need common equity to leverage their balance sheet for further growth. I know that issuing a block of common stock today without an immediate use of proceeds is dilutive to EPS, and negative carry abounds. You mentioned the ATM product. I love the ATM product. I think it is a fantastic and efficient way for clients to put a program in place where they can use it or not use it, not too dissimilar from a share purchase program. And as you see new loan growth in Q1 or Q2 of next year, you can tap it to bolster your common equity. It's also basically a huge lawn sign for larger investors looking to buy a new block of stock should you be willing to issue a larger quantity. At the market means a 0% discount to market. Pretty simple. Most of the issuances we've seen have had 4 to 6% discounts. So I think an ATM beats everything we're seeing in terms of overnight capital raises in 2024, and it allows for just-in-time capital to suit your needs for loan growth.
And could you still raise a pretty big slug there if you wanted? I mean, the way you talk about it, I follow it, that you can bring it in as you need it. But does it allow the optionality both ways?
If you have a round numbers $100 million ATM that you announce on Monday, and an investor calls you and says they want to take down a $20 million block, you now have the ability to place $20 million of stock with your shelf offering, with the ATM that you announced, to that investor. When I say it's a huge lawn sign, it means you're willing to sell shares, and you have notified the SEC and your investors that you are planning to potentially sell shares. So all these investors that are calling clients saying, listen, don't issue stock, but if you do, I want to buy some. They now know that there is a willing seller. And so the best way sometimes to get a lot of stock sold is to announce an ATM, also known as a dribble out program. And you'd be surprised at how fast those programs get closed out, because it is an open invitation for larger institutional investors trying to build a position in your stock to buy a block.
And we've seen some of it. I'm not necessarily saying this year, maybe we have, and I'm missing it, but we have seen it historically, but it hasn't been a very common thing in bank land. Is that right?
It has not been as well received as I think it should be, and I'm going to be an advocate for institutions to have those in place. And I don't know when the next time a stock price is going to rise 15% across the board like we saw at the election. But for those who had an ATM in place at that point in time, they could take advantage of it immediately. And I think it is, again, just a wonderful way to reduce negative carry and reduce the dilution, but make sure you have constant access to the capital markets at the lowest possible cost to the issuer.
And kind of building on that too, maybe this applies to any deal outside of an ATM, but if you're contemplating a capital raise, you might not be ready to do it. What do you recommend to a management team and a board? What steps do they take to start that process so they are ready to go when the time comes, rather than say, "Oh man, we wish we didn't miss this window." I know you talked about the ATM allowing greater optionality in that, but still, what first steps would you recommend banks taking now that capital is coming back in the sector?
There's a multiple step checklist that we would have to share with a management team and a board to ensure that you are well prepared. I'm an ex-military guy. I kind of like preparing everything prior to public release, and an extra day of preparation can sometimes save a lot of dollars in terms of execution and any potential missteps. That includes ensuring that you have the right legal advisor to ensure that the company has the documentation in place to issue public securities. That includes the requisite effort to ensure you have the right list of targeted investors. Again, if you're going to do an overnight offering and you exclude some of the folks that have been in your stock for a while, they have voices, they have phones, they will express their discontent, and they should. So investor targeting is important because you want to place the shares with investors that know the story and will embrace that ownership for a period of time. And I also think that marketing matters. Now, if this is just an offering to bolster the balance sheet to talk about future growth, you're going to need to be able to explain why you are issuing stock and not just rely upon general corporate purposes. Again, the easiest transactions are the ones we're doing where you have an M&A transaction or you have a balance sheet restructuring that is new information, and investors will see this and understand. If you're trying to raise capital for growth, you're going to have to ensure that you explain to institutions kind of why you're doing it, and perhaps you have laid the track for that over the prior months and quarters so that it isn't a surprise to investors. Investors are like parents; they don't like surprises.
Right. And the two examples you gave could be franchise changing, certainly in M&A, but maybe even if you're talking about restructuring your portfolio, whereas growth is more business as usual. So you better have sold your audience on that business as usual.
That's correct. And again, just the timetable for issuing common equity in the public markets, sometimes surprises small bank management teams, and getting your arms around that and make sure you have the right team in place, be it the team for the company that will be executing the marketing documents, the legal team that will be assisting as outside counsel for diligence and for the requisite comfort letters, and the underwriter I think plays an important role too. But getting that team together and sitting in a room and playing it out patiently, I think usually leads to a more efficient outcome.
Great. Well, in closing, we've talked a lot about common and equity coming back. What about the sub debt market? What does that look like today? And how do you think about it in 25 as we see a lot of the paper issued in 20 move from fixed to floating rate? I mean, it depends on where rates are, but even with a couple of cuts in hand, those raises could get kind of expensive. So it seems like there's a refinancing, I don't know if need, but maybe opportunity out there for some institutions. What does that look like to you in 25? And do you see investor support for those deals?
The issuances that we saw on the back end of the pandemic in late 2020 and 2021, for the most part, the majority of the Tier 2 instruments issued, the subordinated debt, as well as the preferred stock, came with 5-year call options. And in some ways, it's like the Investment Banker Full Employment Act. Every 5 years following a rush of issuance, we're kind of back at it. So it's a wonderful thing. Our head of debt capital markets has a tracker that has basically every issuance done and then forwards and looks forward to the call date as well as the reset. Most of these, not only with the call date, came with a reset where they would go from a fixed rate coupon to a variable rate coupon. We went from low interest rate environment in 2021 to a higher short-term interest rate environment in 2024. And so the variable rates that are coming into play after 5 years of issuance have a bit of sticker shock. In some cases, we're looking at double-digit coupons for issuers just because SOFR is so high relative to where LIBOR was back in 2020 and 21. There wasn't even talk of SOFR back then. So what we're doing with clients is as follows. We're looking today, even if it's going to be a call date in the summer, again, proper prior planning, to look at whether or not, they need to replace it with Tier 2. I mean, the best way in some ways to remove the dilution from a Tier 2 instrument is just to call it. And so while that's not good for the investment banking community, it's the right thing to consider for the issuer. So if you can call it and you don't need the Tier 2, call it. And therefore, whatever coupon you were paying goes back into earnings. You don't have to worry about the reset. And if you need the Tier 2, then start the process now to think about how to replace it. And again, a lot of the conversations that we're having today are for issuances that will be to replace callable securities in June or later of 2025. The concern I have about the buyer universe for these securities is that a lot of what we placed in 2020 and 21 for the subordinated debt market in particular, we sold to community banks. They viewed these sub-debt instruments as good opportunities for their securities portfolio. And I think that, as we all saw when rates rose, these securities were underwater in terms of their market value. And we were concerned 6 months ago that the community bank buyer universe for sub-debt might be negatively impacted. If they buy more than half of the securities like they did in 2020, if that goes away, we have a negative impact for spreads and pricing. Thus far, the community bank buyer universe has returned, maybe not as robust as it was 5 years ago. So I think that we will be able to find replacement Tier 2 or Tier 1 for those that have callable securities and are a little bit struck by how much more expensive it's going to be given the rise in rates. There's a preferred stock offering last week that was inside 8%. That was fixed for life. As I told my team on Monday, perpetuity is a really long time. So if you believe that your cost of capital is going to be less than 8% for the life of your franchise, let's talk about seeing a preferred stock issuance to be a part of your capital structure. But the short answer is I think that there's going to be a very robust issuance market for subordinated debt and preferred stock in 2025, mostly driven by the fact that coupons and dividends are going to rise given the rate environment change. And some institutions can call it and not reissue, and that's going to be beneficial to their EPS. Those that need the Tier 2 or Tier 1 are going to find that they can reissue securities at lower rates on a fixed rate basis to start than their reset values after the 5-year call date.
And still offer attractive yields to the investment community or the end buyer, if that is a bank or whoever it is.
That's correct. That's correct. Although I want to be on this podcast in 10 years and look back to see if 7 5/8 was the right perpetual rate for a preferred, but we'll cross that bridge, Nate, in 10 years.
Hey, that sounds good to me. Well, I think that's a great place for us to leave it. Thanks, Bill, for coming back on the show. Do appreciate it.
My pleasure. Have a wonderful Thanksgiving.
You too.